Okay. Well, thank you very much for the introduction. It is a pleasure to be here, and it's been listening to some. Yeah, it looks like you had a great start to the morning today. Um, Obviously, this is a great time to be having such a wonderful event, and thank you, Renee, for hosting. It's a privilege to be here, and we've gone through obviously about 2, 3 months of record levels of no action. uh, there's um, uh, there's been such a lack of volatility in the S&P 500 and US indexes over these last few months. I think the last time we had it was in July of 2003 was the last time there was such a lack of movement. And we've gone from that to basically turbocharged levels of movement. And of course, everyone's now sitting and wondering, well, what next? Where do we start taking the opportunities? And that's what we're going to be talking about today. Is basically where is the highest level of opportunity, and how do we focus on those? How many here are hearing me for the first time? Who is brand new to Acorn and our way of thinking? I see a few of you that I definitely recognize the names of. Hello, Abdul. Good to see you, mate. A lot of Acorn students here in the room, which is good to see. Okay, well, I'll give you a quick breakdown. My way of thinking is that in trading, we want to keep it really simple. You know, that the world is complicated enough. We want to kind of take out of the equation emotions, feeling, thinking too much. Those are things that don't have a place in the trading world. We want to be able to react, have rule-based decisions, and the simpler we keep that, the easier it will be to make money. Um, so the KISS principle, essentially. Uh, in the stock market, I believe that my opinion has no place in my trading. So what I want to do is I want to be able to make quantifiable decisions that are purely based on rules, so that I can say, not do I think, is this a good trade? Do I think? Wrong question. Does it meet the rules? Yes or no? Is the right question. So a good trade isn't necessarily one that makes me money. A bad trade isn't necessarily one that loses. A good trade is one that meets the rules and I take it. And I can tell you something interesting, that some of the trades that have made me the most amount of money this year were the most painful or difficult to take, because I completely intellectually disagreed with them. I thought, there's no way the market could go up right now. That's crazy. Who in their right mind would buy stocks right now? But the rules told me it's going to go up, so I got in anyway, and it went up. So anyway, that's I guess the focus today is how do we start creating those rule systems. Most people in the stock market fail because they don't take action. Most people in the stock market don't take action because they are struggling with some kind of these emotional problems. They don't know when to get in and when to take profit. They don't know, they sell too early before a stock goes from a 10% gain to a 30. They don't, and they not only sell their winners too soon, but they sell their losers too late. So they minimize their gains and they maximize their losses because they're afraid of the losses they've had before. They see a 10% gain, they think, oh, I'll get out now before it evaporates, and they lack the confidence to execute their decisions. As I said, the main problem of why people don't make money in the market is because they lack a system of rules. And I had this conversation actually with one of our Acorn students. I'm working one-on-one with a gentleman at the moment, and his comment to me yesterday was, he said, John, I'm curious. I'm going back and he just completed a strategy that I call the Fallen Angel strategy. It is an amazing strategy. And he said, John, I've noticed that a lot of the stocks in this pattern go up at least 10%. Like if I was to have bought them all, I would have made almost every time 8 to 10% on each of those trades within a 1 to 2 week period. I said, you're absolutely right. That is the average performance of that strategy. And he said, well, right, okay, but with the other stocks, excuse me, with these types of strategies, I noticed that maybe 80% of them then pull back to the entry zone right after that 10% is hit. And the other 10, 20%, will go 30, 40, 50% up. He's like, how do I know the difference between the two? My comment to him was this. Well, why, if you know that 80% of the stocks, or 100% of the stocks, let's say, all go 8 to 10%, and 20% of them fail and pull back to the entry zone, why would you bother risking that 10% gain you've made on 8 out of 10 trades to chase the extra 20% on the other 2 out of 10? And again, it was a lack of an understanding of these rules. So the main thing that we want to talk about is how we create systems that really give us some kind of a structure to make decisions, not based on whether we're going to make the most money on this one specific trade, but how do we create systems that give us a strategy for every trade? How many people struggle with that, by the way? How many people are well educated maybe, but struggle with having a system to approach everything with that gives you that structure? The main thing you want to do is you want to take risks, take calculated risks, but that's very different from being rash. We want to create systems that give us a calculated risk that fits into a systematic approach. Now, there is a movie that that maybe many of you have seen. Let's go back. I like this slide better than the next one. Good photo. Let me ask you something. How many people here have seen The Big Short? Excellent movie. I had the blessing of meeting my partner in Mexico 2 years ago. She's a dear. She hates stock trading. She thinks it's all about finance and charts and mathematics and economics. She's not interested in. And I just accepted that. She hears me talking about it all day long, but it wasn't until she watched The Big Short that she suddenly understood why I'm so passionate about stock trading. We watched that, and at the end of the movie, she turned to me and she said, all right, I'm ready for you to teach me how to trade. Fascinating movie, and what it talks about essentially is how a small group of people scratched away at the surface of what was going on in the stock market and said, right, there's a huge opportunity here to short this market and make a killing. Now, they did. They figured out that things didn't add up. Based on the rules, based on the numbers and their quantifiable system, they said, right, things really don't make sense. And we're going to short this market, and we're actually going to raise money and create investment vehicles to do so that don't even exist, so that we can leverage this opportunity. Who's seen that movie? It's amazing. And if you've never seen it, that's what stock trading is all about, is ideas like this. Right now, we are in a scenario where we could be at the tip or absolute top of the market. I've been hosting this lesson called Market Meltdown, this webinar, now for the last 6 months. We haven't been teaching anything else in our free workshops like today. We've just been trying to prepare people for the market that we're in and possibly this crash that's coming. How many people here, by way of by way of a survey. I'd like everyone to raise your hand and say yes. If you feel that it is not a matter of if the market will crash, but when the market will crash. That's my opinion. It's not a matter of if, but when. Okay. Perfect. A lot of people. If you don't agree, please raise your hand as well. Okay. Yeah. And if you don't agree, that's awesome too. Throw out some reasons, and we can look at those. I'm going to show you. Now, I'm not here to be a fearmonger. I'm not here to ruin your weekend, or to suggest that the sky is falling. I know some people do that. I'm not one of those people. I'm simply looking at the facts, and as a trader, I want to be prepared, very well prepared, for if it does. You've got to be prepared for both scenarios. So the purpose of today is to have a look at what those warning signs are, how we prepare for it, whether it goes up or long. And Rob, great comment. The market will tell us, no opinion. But what we have to do is we have to see how do we measure what the market is telling us, because I think that message is loud and clear, and I'm going to show you why. All right, so let's fast forward a little bit, because we only have 45 minutes here instead of I usually talk for about an hour and a half and still don't get everything said. So let's fast forward a bit. We have to have measuring sticks. We can't make emotional decisions. 95% of traders lose statistically because they don't have systems, and the stock market does. The stock market has a very good system of taking your money, because it drives people to emotional-based decision making. That's why 95% of people lose, not because we're stupid, not because we don't know stuff, but because we are emotional people, and the stock market doesn't tolerate that. So when we sit down as a trader and we say, right, well, let's go make some money, we need to have a way of disengaging that emotion to be systematic. And so as we go into what our favorite strategy to trade this market is right now, I would open this topic up by posing the question to you of, if we were to sit down, if I was to give you a pen and paper and I was to say, right, what is the perfect, if we're going to short the market, what would the perfect short look like to you? In other words, I'm going to spend the rest of my weekend finding for you the perfect short. Draw it for me. What would you draw? If I would commit to you the rest of my weekend to sit here and scour the market for exactly what you're looking for, what would you ask me to find? What would that chart look like? This is very important, because if you don't know exactly what you're looking for, why are you bothering looking for it in the first place? A lot of people do this. They wander through Wall Street. They look at chart after chart after chart, hoping that they'll stumble across something that'll make them rich overnight. You need to know what you're looking for. So, if you were to ask me, so please throw in volume disappearing, no buyers, downtrend, okay? But you need to be much more specific than that. Let me tell you what I mean. Let's use MS Paint. So let's talk about the perfect short. So if I said, all right, what would you draw? Obviously, we're dealing with a chart first. Some people might say fundamentals. Let's start with technicals first. Now, let's firstly say what controls the market. All right, volume controls price. Who controls volume? Smart money. 80 to 90% of the volume in the market comes from high frequency trading. Okay, dig deeper. How does high-frequency trading make their decisions? They make decisions based on patterns, based on algorithms, based on rules. Okay, next level. How do the rules work? They work based on support and resistance. Okay, great. So, what types of support and resistance or patterns exist? There are 100 patterns that exist in the stock market, 100 plus. And to give you an example, let's talk one of the most basic ones that we can deal with: a double top. You can have an Adam and Eve double top. You can have an Eve and Eve double top. You can have an Eve and Adam double top, and you can have an Adam and Adam double top. Did anyone not realize that there was 4 types of double tops? And just so you know, you would never trade that. You would never trade that. You would never trade, well, you may trade this, but this is the one you want to trade. On a practical level, this ranks number 13 out of 100. This ranks above it 49 out of 100. So why would you ever trade an even Eve when you've got this scenario here? Okay, this is this type of strategy, or maybe this type of strategy applies in one of our recent top performing picks. This is our number 1 favorite stock alert that we sent out. Penske Automotive Group. Okay, so here you go. This is a double bottom, but can everyone see that? There is an Eve and Adam double bottom. Eve and Adam. So rounded bottom on the left, sharp bottom on the right. And what that suggests is that it will break out an equal distance from the support to resistance. That's how much it should break out. So we're looking for a target here of about 52. Now I always go conservative, so I look at a little bit lower than where that extension should be, but that's perfect. Those options are up 288% from where we alerted it at. The most important thing here is the pattern made sense. So figuring that out, knowing what you would draw is important, is key. Okay. All right, so question. Let's chart that on a 240-minute. We can come back to that, sure. But there is really, when you look at a stock, when you have a look at any kind of idea, the most important thing you need to do is to look at where is support and resistance, and what pattern does that make? Question: isn't the head and shoulders between more important? Are you talking about in the middle here? Well, that's already finished. Because remember, so that is already played out. So yes, that head and shoulders would dictate a target of this, but that's now over as of there. And after that pattern ends, then we're looking for a new one to begin. Let me show you another example. Because technical analysis, if you do it right, is fascinating, and it's so rule-driven. Okay. Look at the market itself. For anyone who doesn't believe the market is predictable, doesn't have a system of technical analysis that's working for them. It's an excuse. Market's not predictable. Why? Because you're not making money. That's usually the reason. Market is very predictable. In fact, if you want to look at the S&P 500, the entire crash of 2006 was highly predicted. Now you might say, John, 2006, don't you mean the crash of 2008? No, I don't. It's the crash of 2006. Why? Because that's when it started. The stock market was going up in a 4-year upward channel. For those of you who don't know, an upward channel is bearish. An upward channel predicts that the market is about to drop. It's not a bullish technique. So basically, what you do is you're waiting for 3 touches off of support for the trend to change. As you can see here, 1, 2, 3, 4 touches. What happened after that upward channel was broken is the S&P 500 then formed a head and shoulders. There you go. Head and shoulders. Left shoulder, right shoulder, head. You measure from support to the head. That's how much the market should break. So that tells, so when that pattern is broken, that tells us where the target is. That's exactly where it dropped to. Okay, then what happened? Another head and shoulders. All right, there we go. Support to the head. We measure that. That's exactly where it broke to 1,000. It then broke beneath that level. That's exactly where resistance was, and it bounced underneath that for a while. We then had an inverse head and shoulders, upside down. So anyone who says, oh, 2008, 2009, that was chaotic, that was unpredictable, rubbish. It was perfectly predictable because it dropped exactly where it should have dropped to. Now have a look now. Look at exactly what's happening. Another 4-year upward channel. We have then reversed and broken down underneath that channel. Look at where we broke to. We measure the distance from the top of the channel to the bottom of the channel. That's how you trade a channel. That's how much it should drop by. So we measure that. We move it over here. Okay, that's the measurement. It breaks down. Look at where it dropped to. Exactly where it should have. Exactly. Okay, now look at what pattern we're forming. Does everyone see what pattern we're forming here? We broke down, we rallied back into resistance, broke down again. Can everyone see what we're forming here? A head and shoulders. Target on the S&P 500, 1980. Second target on the S&P 500, 1700. Third target on the S&P 500, 1930. Fourth target on the S&P 500, 1300. This is my market strategy. If we break lower than 2120, I'm going to be shorting the hell out of the market. I'm going to be taking profit here and here. I'll then be going long at that level, very significantly long. I'll reverse all my positions and going long at that point, and then short again when we get to there. If we break above 2120, I'm prepared for that as well, and I've also got my favorite list of longs. And if we broke above the Fibonacci level here, what level is that at? It is at 22.3 Fibonacci. 2200. If we break above 2200, I'd be going long to a target of 2297, and I'm prepared for that as well. But the more likelihood is that we go down. So then we start to incorporate this idea of technical analysis. Okay, now let's go. So an example of how we look for good trades. It's something like Marriott. Now, Marriott is a great example of the type of stock that I would short, therefore, based on that approach. Have a look at Marriott. Marriott, first thing you need to do whenever you look at a stock, this sounds interesting, but I have to leave. Can you send me info? Sure. Shoot me a quick email there. I'll put my email up on the screen while I'm explaining this stock to everyone else. By the way, this is not something you really have a lot of time for. This market could break down as soon as next week. It already is, and I'm going to show you some really scary stuff here in a second that would But yeah, if info@acornwealthcorp.com. Just shoot me an email there. I'll send you the info. Have a look at something like Marriott. Uptrend channel. Uptrend channel, you can see the support is definitely visible there, and there. Okay, so 2 touches so far. It has a over 30% short interest. So 30% or more of the stock's available shares are being shorted. That's very heavy. Let's look at the pattern. We have a downward channel. Okay. Now this is technical analysis at its best. This is why you need to identify support and resistance, because it tells you everything. Where is support and resistance? Support is here, resistance is there. Let me throw a question out there. Johnny, why are you looking at what happened in March and April? What has that got to do with today? Everything. Because by looking at what the pattern was there, we can see when that pattern ended. By looking at when that pattern ends, we know when the next one begins. By knowing that, we then know what pattern is happening now, because we know where to measure from, because we know when the last one ended. Does that make sense to everyone? Okay, so we see that this pattern was a down channel. Down channels are bullish. All right. What happened at the end? Right at the end, we have a bullish flag. Okay, that is a flag formation right there. Okay, so we know that there's a flag there. So we measure the flagpole. There we go, that's the flagpole. We duplicate the flagpole because a flag should go up an equal amount, and that's basically exactly where the stock went to. Have a look at that. There you go. That's exactly where the stock went to. Exactly. Okay, then after that flagpole move, that's where you would have sold and took profits. We now know that this is where this pattern ended and a new one began. Okay, now we go into a rising wedge. We'll measure that distance from the top of the pattern to the bottom, just like a channel. Okay, and in fact, if you look at that as well, there you go. Have a look at that. Can everyone see that the flag, it went to exactly where it should do? And in the larger scale, look at the channel that went to exactly where it should do as well. That is the top of the channel. Look, measured perfectly, bottom to top. That is exactly where the stock ended up going in the longer term. $74. Exactly. No guesswork here. Okay, then it broke down. How do you trade a rising wedge? You measure top to bottom, duplicate it. That tells us, there we go, that tells us that it should drop from $74 to $70. That is where support was. Okay, let's move that, let's put that line there. That tells us that's where support was. That is exactly where it stopped. Look at what happens as it broke down. As it broke that level, it goes from 1.8 million shares to 3.88 million shares. So it broke core support, tanked. Now what pattern do we have here? Now we have a bear flag. Okay, so a bear flag, measure from support to resistance, duplicate it. That tells us that we should drop from 68 to 64. Right? Now, this is something, therefore, that we can take advantage of as a great short in the weakness of this market. A break below 63 is what we really want, and that would be a pretty damn awesome short. But I don't have to feel anything about this. So right now, all of the rules that have predicted perfectly well since February of this year have predicted exactly where the stock should go and did go. I don't have to worry about what I think about Marriott. In fact, I'm sitting in one of their hotel rooms right now. Love the place. Wonderful hotel. Would I buy the stock? Rules tell me no. Let's go and have a look at some of the other rules. Let's have a look at what the insiders are saying. Okay, there we go. There's the Marriott. There's the insider selling report. What do you think about that? Comment. Let's see what happens to those flags after Jeanette talks on Wednesday. Okay, I understand what you're saying, but to be honest, any kind of fundamental report is technicals trump fundamentals time and time again. If something fundamental is announced, the stock that will move the market, but it will move the market to where technically it should go. Great example of that, Lululemon. This is one of our favorite shorts recently. Now we alerted this to our students on Tuesday, August the 30th. We said, look at buying some September $75 puts. Why? Because have a look. Technically, beautiful rising wedge formation. Measure from the, as we've done before, from the top to the bottom. Duplicate that beneath. That's where it should drop. The technicals told us that this was going to drop from 78 to 68. And look at exactly where it dropped based on fundamentals. It went to its technical level. And as you can see, as the stock built up, look at the smart money indicator down the bottom, Twigs money flow, was dropping away. These are the types of opportunities you want to have a look at. Johnson & Johnson, we're short that one as well. This one, if this breaks 116.50, this one's headed for the tank. Strong company, but dropping. Okay. Can I have a look at Apple? Sure. Yep. Oh, sorry, Peter. I see a question. I'm currently short the SPY, but confused what I should do next week because most likely the Fed will not raise rates. Agreed. Which should make market rally. Would you exit the SPY short then ahead of the Fed meeting? Why would you? Let me ask you something. Why short the SPY? Why would you short the market instead of shorting individual stocks? The only reason that I can think of is volume. I never play the market itself because you're dealing with the most manipulated vehicle you could possibly come up with. All of the market makers, all of the the garbage that goes on, that's going to be the most present in the market itself. I do not short or go long the stock market. I do not believe in the stock market. I believe that it's not a stock market, it's a market of individual stocks. What makes me money isn't predicting the stock market, it's finding strategies or patterns that are incredibly successful and then finding individual stocks where that probability is extremely high that that pattern is going to work. Things like Penske Automotive Group. Because the idea, a good stock trader should have a strategy that's so successful that they can make money going long in a bad market. So if you have a good strategy, you should be able to find longs that succeed even if the market was to drop 10%. A good stock trader should be able to find shorts and make money at those in a market that keeps going up. We have. I mean, look at LLY, another example, another one of our shorts. Market has gone nothing but up. Lilly stock we recommended a short at $82. As the market goes up, students that took this trade have been making money on this going short. That's the test. Right? And if you can't short stock, you buy puts. Anyone can short the market. All right. So let's have a look at, we only have about 5 minutes left. Again, I told you I could talk for hours, and I'd love to. Let's talk about where the market's at right now and what we're going to do about it. This is a very, 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 very serious situation. This isn't just any weekend. We have had record levels of no movement. Why? Because the market has been held and propped up for months so the smart money can exit. This is what's happening. Not because it's my opinion, but because I'm looking at the numbers. This has been building for a while. We went heavily short the market back in December. They said, wait for the Christmas rally. Smart money was flooding out of the market. We took our corporate options trading account, because we trade two different strategies, stocks and options. Our options account, we went into 15 option positions on December 11th. By February 11th, we had tripled our corporate trading account. It was all based on what I'm about to show you. We are getting the same signals now. Smart money wants you to think the market's going up. That is a key indicator of a crashing market, is when optimism is at its highest. Best trade we recently recommended on the long side was a calls on UVXY. This is still a very good trade. Have a look at the VIX. If you look at the VIX, the volatility index of the market, and you look at this over, I don't know, let's say forever. If you are a technical trader, you understand support and resistance. The VIX has never gone below 10, ever, never, ever. Okay, have a look at this now. Where are we at as of a couple of weeks ago? 10. Record levels of complacency. If you understand risk reward, if something over the course of 15 years has never gone below 10 and you're at 10, and every time it gets to 10 it goes to at least 20, what does that tell you? That tells you that there is 100% upside with almost a 0 probability of going below 10. Right? This is awesome. That's why the VIX has been such an awesome trade. Of course, you can see there, that's exactly what happened. So we picked this out as a long and recommended, I think it was 15 or 25, 15 and $25 call options. I believe March calls. And have a look, bang, there we go. That's exactly what happened. Up from $11 straight up to 20. You can see we're now consolidating in a flag formation. As a flag, we're likely to go further. We are in a very interesting market. Asian economies are crashing. Bankruptcies are just around the corner. I mean, I don't want this to happen. I don't want the market to crash, but if it does, I'll be well prepared for it, and it'll make me a lot of money. And I hope you too. You do need to be prepared for these things, because you can't wait for the next Lehman Brothers and then short the market. No one is rewarded for doing that. You have to be prepared. They didn't make a movie about the boys and girls in the Big Short because they reacted after everyone else knew as well. Their movie was made about them because they knew what red flags to look for. When things start to fall apart, it's too late. Liquidations happen. In the stock market, gold and the US dollar has been going up at the same time. That is rare. That only happens in 2008. We've had Bank of America release a report that we've had more selling than has ever happened since 2008. And all the things that happened before 2008 crash are exactly the same right now, if not worse. It would be insane to say, right, well, all of the indicators that could have warned us about 2008 are happening now. Let's ignore them. That would be insanity. The market, someone said earlier, the market will tell us. It already is. The insiders, this is the insider sell to buy ratio in March. Remember, March was when the market was rallying. April, insider sell to buy ratio. May, June, last 3 months put together. There is about 50 to 1 insiders selling versus buying. In the most awesome rally we've had since February, they are getting out. The patterns, the S&P, the head and shoulders, telling us out. So we're short on time, so I will have a quick look at Apple. Let's fast forward. This is an amazing opportunity to short this market. There are some incredible short opportunities. Marriott is awesome, I believe. How much time do we have? We have about a minute left. So this is a course that I think that you would be very interested in. It is a excuse me. There we go. We just launched this on September 7th, and we have recorded this opportunity. Okay, so it is acornwealthcorp.com/storm. It is a 4-module workshop that you will get on demand, and what it's going to do is teach you all of the scans that we are using to find these opportunities. You can these are pre-programmed, the Smart Money Indicator and Smart Money Scan in TOS, in Incredible Charts, Metastock, TradeStation, Thinkorswim, TC2000. We have developed the Smart Money Scans that finds these stocks, and will find where these opportunities are located, where the smart money is selling. We'll also be providing for you our favorite longs and shorts. Okay, these are scanned with over 30 criteria and technicals. What we're looking for, this list that you'll get, what we're essentially looking for are stocks where we have record amounts of insider selling in a sector or industry where the highest amount of insider selling is occurring, so the weaker sectors in a weak market. We're looking to a debt to equity ratio that is at record levels. So huge debt to equity ratios. We're looking for institutional selling. We're looking for when the insider selling is happening, that the insiders who are selling have a track record of always being right. So we're looking for stocks where if an insider has sold in the past, the stock dropped 30–40% after they did. We're looking for those stocks. We're also looking for the pattern. We're also looking for the money flow. We're also looking for negative aspects in terms of at least a 30–40% decline. We're then looking for options that are cheap enough with a low implied volatility that we can buy them for 15 cents and an opportunity to sell them for $1.50. So we've got like a 1-year window with a 500 to 1,000% upside if it drops. These are all of the criteria that are built into the scan. Okay, and you'll get the video of our favorite alerts with options attached to it. That's included. Live class also included, Tuesday and Thursday. All right, now we've got to wrap up. Sorry, I've gone over my time. So it's acornwealthcorp.com/storm. I don't have time to tell you all the things, but one little bonus I'll leave you with is you'll also be included a one-on-one personal mentoring session as well that you'll get to implement what you're learning. All right, so we're going to have to finish up there. I'll leave you with the Apple chart. What would you do with Apple? I'll tell you what I'd do with Apple. I would be short Apple, but if I had to make a decision on that, I would be short around 120, 125. But I think there are much better shorts than that. So I wouldn't be long and I wouldn't be short because I think that it's a strong stock and it's heavily manipulated. So I wouldn't do anything with that. If anything, I'd be looking at AVGO, which is the semiconductor company behind Apple. And I'd be shorting that. Once, if it broke 160, I'd be looking at 160 puts. It is a one-time charge, absolutely. If you want to subscribe to our alerts, we send out video alerts every night. You'll get the option to add that for $9 when you enroll. Folks, I have to go. You have a great speaker coming up next. Kat's in, terrific. We'll see you there. Look, we'll see you in the live lessons Tuesday, Thursday. I hope this has been helpful for everybody. Be prepared, be ready. This is I might be wrong. I hope I'm wrong, but if I'm right, this is an opportunity that comes around usually statistically once every 10, 15 years, and you don't want to be on the wrong side of it. Be prepared, and I hope this course will get you there. Ladies and gentlemen, thank you, and everyone over at MTI, thanks for putting on a terrific event. Have a wonderful weekend.